Hi everyone, and thank you for tuning into my channel where I post about stocks, stock market, and investing on a daily basis. If that sounds like something you're interested in, please subscribe below to get in on the action. Alright, so today's video is going to be on answering the question if DraftKings stock is a buy. And I'll be doing that using my simple 6-step framework for analysis. So let's get right into it. The first step in my framework I like to consider is the customer value proposition. So for DraftKings, if you're not familiar with the company, they run an online sportsbook, they have an iGaming option, and they have daily fantasy sports. The main value that DraftKings provides is convenience to people looking to place wagers. Consider that previous to having the option for online betting, online gambling, people had to drive maybe hours to their nearest casino just to make a wager, to make a bet, play a hand of blackjack, anything like that. So now with something like DraftKings, you can open up the site, open up the app, and place your bet within seconds. So huge convenience there, and that's a big positive for customers for the customer value proposition. So looking at their revenue increasing from 192 million in 2017 to 1.3 billion in 2021, it's clear that customers appreciate this convenience that DraftKings is adding. So they're voting with their dollars and they're voting in favor of DraftKings. So it's not only the players that DraftKings must consider, they also must consider governments, state legislators, because without getting the approval of governments and legislatures, DraftKings cannot access state markets. Before this video was before I was recording this video, DraftKings was live in 17 states with sports betting and 5 states with iGaming. So far, those are the areas they've gotten approval to enter. Moving along to my next step, which is unit economics. And for DraftKings, you they're a gambling company. So you've heard of the saying, the house always wins? Well, this is even more true for an online gambling website because the odds are almost always in DraftKings' favor. It's literally coded into the games. It makes sure that out of every game that's on the platform, the odds are in its favor. In the long run, DraftKings stands to win. In the short run, there may be fluctuations where customers may go on a hot streak and win a few games and win some money and get hot and things of that nature. But over the longer run, if you look at over 1,000 wagers, DraftKings is going to be in the green most of the time. And compared to traditional casinos, an online game gambling website like DraftKings has lower overhead costs. Imagine they don't need to pay for massive to build massive resorts and hotels and pay dealers and cashiers and food people and cleaning personnel and all of the overhead that goes into running a physical brick and mortar casino. DraftKings can step aside those costs. However, despite these benefits, DraftKings is still generating massive losses on the bottom line. So what's up with that? And I'll go deeper into that um, when I get into my segment on competition. So one of the other steps in my framework is looking at the potential market opportunity or the total addressable market. And according to Statista, the online gambling market in the US rose by 800,000 to reach 9.5 billion in 2021. So, a small market opportunity um, overall so far. However, there is the potential to expand both domestically and internationally. Recall earlier I said that DraftKings is live in only 17 states for sports betting and 5 states for iGaming. There's a potential to get wider market access. Now, they're not going to enter into every single state. There are states like, I want to say, like Utah, who is that are a little bit more skeptical about allowing gambling businesses into the state. But they are likely to expand from their current base of just 17 for sports betting and 5 for iGaming. But for now, the total addressable market is small. My next step to consider is competition. And the competition in the online gambling industry is extremely high. Companies including DraftKings are offering massive bonuses to attract new customers. You could think of deals like um, deposit $200 and we'll match your $200. After you take that initial $200 deposit, you might see an email from DraftKings telling you if you add another 100, we'll match your 100. Or you might see offers like place a $5 wager and if you win, we'll put $25 into your account. So these are all promotional activities that highlight increasing competition. Um, this is not good news for investors. Investors would prefer an industry with limited competition, and that way profitability is higher. And these promotions, these offerings, is why DraftKings is generating massive losses on the bottom line. Its highest line item expense on its income statement is sales and marketing. DraftKings spends a ton of money on sales and marketing, and those promotional offers are accounted for as sometimes are accounted for as sales and marketing. In addition to all the commercials and TV advertising that DraftKings undertakes. Um, so the high level of competition is partly why DraftKings is having difficulty generating profits on the bottom line. Further, there is scarce differentiation among gaming providers. When this is present in an industry, it increases competition based on price. Again, bad news for investors. If a company can differentiate itself, offer something that is unique, that attracts customers, it can highlight this advantage in advertising in promotional material, and that way it can attract customers and keep customers. But placing a wager on whether or not the Dallas Cowboys are going to win the Super Bowl or the Los Angeles Rams are going to win the Super Bowl is a very similar transaction, and the several different gaming providers, they're going to have difficulty telling customers that our website is better, our website offers better wagering experience. And so for that reason, they are competing on attracting customers based on promotional activity, offering the best bonus, the best reload bonus, and things like that. So the next step I like to consider in my framework is valuation. And looking at it here, the chart shows that DraftKings stock is relatively inexpensive. I'm using the price to sales ratio because DraftKings is not profitable on the bottom line and they're not generating positive free cash flow. And so price to sales is one of the few options we have remaining when we want to look at its valuation. And its price to sales ratio of 4.4 is near the lowest it has been in the last 3 years or so. That's all down from the highs of over 36 it was in its peak in 2020. So relatively inexpensive compared to its history. The final step in my framework are risks. So gambling businesses are typically at the mercy of government regulation. I mentioned earlier that DraftKings needs to get approval from each individual state to operate in the jurisdiction. So without that, they will not be able to operate there. Further, even though they gain that, it's not a permanent access to the state. States can reverse those arrangements and deny them the ability sometime in the future to participate in the states. Now, this might not be an apples to apples comparison, but you might recall what happened with the online poker industry in the US about 2 decades ago. That was a rapidly growing industry similar to how sports betting is now online, and they were growing users and revenue quickly, and then all of a sudden the government passed legislation making it illegal, and the industry almost overnight shrank by 90%, and then over the following decade the remaining 10% also almost completely vanished. And now I believe online poker is only available in a couple of states. It's really, really small compared to where it was 2 decades ago. And so that there's a risk that online sports betting and online gaming could follow a similar fate that online poker did 2 decades ago. The next risk, the wagering outcomes. Of course, it's a risk for DraftKings if someone makes a bet of, if someone goes on a really hot streak and wins a few $1 million in a quarter, that could hurt its financial performance in that quarter. However, over the long run, it's not a risk. It's not a really meaningful risk as long as the company is properly capitalized. So if DraftKings has enough money to withstand those short-term fluctuations of wagering outcomes, then the if someone goes on a hot streak or if a group of customers go on a hot streak, it's not really a risk. However, if they're not capitalized properly, if they don't have enough money on the balance sheet, then this could be a risk to look out for. All right, finally we've reached our verdict. And so let's review each step in the framework and then we'll get to the final verdict. For the customer value proposition, I mentioned that it's excellent from DraftKings. Customers' other option would be to drive to the closest casino to make a wager, and now DraftKings is saving them tons of time and transportation costs for that. So it's excellent. The unit economics was also excellent in DraftKings' favor, especially compared to traditional brick and mortar casinos. The total addressable market we noted was really small, which is poor. I like to invest in companies that have a large addressable market. That way, there is room for growth for several years, and they're not going to hit a ceiling at a certain point. So for that reason, I rated DraftKings as poor in this category. And DraftKings also earned a poor rating from me for the competitive position in the industry. The industry is highly competitive, a lot of promotional activity. I do not prefer investing in companies that are in these types of industries. Moving on to the valuation, we saw that DraftKings was relatively inexpensive, trading at its lowest price to sales ratio in years, so that's working in its favor. And when we move on to risks, I noted that DraftKings risks are high. The regulatory risk is extremely high for DraftKings. It's extremely reliant on government regulation for its business, for access to markets, for sustained access. And so much of its fate is not under its control, and that is a risk, a very high level of risk. So that's working against it. Overall, when I balanced all of the ratings in my framework, I would say that DraftKings stock is on the borderline. I wouldn't say it's a buy, and I wouldn't say it's a sell. I would put it somewhere in the middle on the borderline. Excellent customer value proposition. The fact that people who want to wager and gamers across the US no longer have to drive a couple of hours to the nearest casino that's going to work in its favor. However, the risks are extremely high and the total addressable market is relatively small. So for that reason, I place DraftKings stock on the borderline. All right, so let me know what you think about DraftKings stock in the comments down below. And if you like what you saw today, please like and subscribe to get more content like what you saw today. Thanks.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.